Okay, the second principle. Make sure you'll always invest in a cash-rich business. When a business is cash-rich, it means it always has abundant funds left over after paying all of its debts and expenses. It also means that its assets are liquid enough to be called upon should they be needed as an extra source of cash. So more cash simply means more liquidity. That's exactly what you'll want to look for as a value investor. And you should always make a point of investing in companies that have a strong cash position, because they're the ones most likely to pay regular dividends to their shareholders. At the same time, these companies are less likely to find themselves so strapped for cash that they are unable to service their debt loads when revenues dip or a recession hits. However, having a lot of cash is not always a good sign. You must find out if the management is utilizing their business cash well. Warren Buffett once said, "When people talk about cash being king, it's not king if it just sits there and never does anything." If the management can't utilize their business assets, it shows inefficiency in the company's operations, and that will be a red flag that you need to pay attention to. And finally, you'll want to look for cash-rich businesses with a long and uninterrupted history of dividend payments. When companies pay dividends on a consistent basis, they demonstrate stability and show a positive sign that after paying all expenses and debts, they still have a lot of cash left to pay dividends to you and other shareholders. And that helps increase shareholders' value, and in some way contributes to a growth in their stock's perceived value. Okay, that's principle number 2. Make sure you'll always invest in a cash-rich business. See you in the next video.